Welcome to 3 Minute Tech. These are the videos where we answer your technical financial planning questions without all of that jargon. Shot on location at our beautiful new offices, Level 37 QV1. In today's episode, we'll be talking about one of the biggest changes to superannuation in decades, Division 296. What is it? Who does it apply to? And how much additional tax will you have to pay? So what is Division 296? Well, it's currently before Parliament and set to be introduced from the 1st of July 2026. Essentially, it's an additional tax for large superannuation balances. This is aimed at redesigning superannuation and making some of the tax benefits a little bit more equal. Well, as we know, the current tax rates inside of superannuation depend on whether you're in accumulation phase, where you'll pay a maximum tax rate of 15%, or retirement phase, where you'll pay no tax whatsoever. However, with Division 296, from the 1st of July 2026, this is going to get a little bit more complicated. For larger superannuation balances, where your individual balance is above $3 million, you'll pay an additional 15% tax on the proportionate earnings. For very large balances, where your individual balance is above $10 million, there's a further 10% tax on top of that. Now let's go through some of the changes to this legislation over the last couple of years. So one of the changes has been about indexation. When this Division 296 measure was first introduced all the way back in 2023, indexation did not apply, and this raised a lot of alarm bells. Fortunately, in the current legislation, indexation will apply. That $3 million threshold I mentioned before will go up in increments of $150,000. And similarly, the $10 million threshold will go up in increments of $500,000. So since the legislation was introduced in 2023, it's gone through huge redesigns. A lot of them have been great redesigns. And as you can see on screen, we've earmarked the main ones. The biggest redesign was how earnings was calculated. Back in 2023, these earnings were set to be calculated on paper earnings or unrealised gains, simply looking at your increase in your balance between the start of the year and at the end of the year. Fortunately, now this will be calculated on realised gains. So how much profit did you actually make and how much income did you receive? Other notable changes include the start date. This has been pushed back to the 1st of July 2026 as opposed to the 1st of July 2025. The indexation, which we spoke about earlier. In addition, there'll be the very high superannuation balance tier of $10 million, which didn't apply in the previous regime. So one of the questions we get a lot is there any transitional arrangements or grandfathering arrangements? In the true sense, there's no grandfathering, but there are some key transitional arrangements to be aware of. For one, how you're assessed to be a very large or a large superannuation balance, so whether you're above the $3 or the $10 million figure, in the first year, they'll only look at your closing balance and not your beginning balance. In addition, you also have the option to using a cost-based reset. So some of those unrealised gains over the previous years, you can bring them back to neutral, ready for this new legislation. Now importantly, the devil's in the detail, and this doesn't reset your cost base from a true tax perspective, but only from this new Division 296, and therefore it's important to seek some advice. So how are the earnings actually calculated? Well, like we mentioned before, they're no longer on paper earnings, and it's actually the realised income or the realised gains your superannuation generates throughout the year. But importantly, it won't be on the full amount. It's only on the proportion of these earnings that relate to your balance above $3 million or the balance above $10 million. And this is something we'll go into a little bit more detail about in our case study. So in today's case study, let's look at Roy. Roy is going to be impacted by this new Division 296 legislation. So let's assume as of the 30th of June 2027, his balance is $4 million. Well, because he's above this $3 million threshold we spoke about earlier, he's going to be impacted by this new tax. But what we're really focused on here is how much of his balance is above that $3 million threshold, which represents 25%. Now, Roy is a really good investor, and over the year, let's assume he made $100,000 of earnings. How much additional tax will he have to pay? Well, the maths is quite straightforward. The balance of his superannuation above the $3 million threshold is 25%, or 1 divided by 4. You then multiply that by his $100,000 of earnings, and you then multiply that by the 15% tax levied under Division 296. So what does it all mean? It means he has to pay additional tax of $3,750. Now, on $100,000 of earnings, this is only an additional tax of 3.75%, but additional tax nonetheless. So what have we learnt today? Well, we know Division 296 creates a whole nother complexity with superannuation. But as we went through in the case study, for a lot of people, it won't mean excessive amounts of additional tax, particularly once we factor in the new changes to this legislation. It's important to seek advice and make sure you can go through with your advisor what it all means specifically to you.